Welcome to the Brokers Lounge with Eddie and Carlo. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you want to book a free call to discuss your personal situation.
Hi everyone, and welcome to another episode of the Brokers Lounge. Today we're going to be talking about all things interest rates, including the role of the Reserve Bank of Australia, how they control monetary policy, how this ties into controlling inflation within our economy as well, and ultimately the ongoing effect that it has on lenders' interest rates. Once again, I'm joined by my colleague Eddie, and I guess I have to start off with the hat, mate. That's very flashy.
Yep.
Need to know a little bit more about it.
That was sent to me by a good friend, Julian Fayad, the CEO of Loan Options AI. Shout out to Julian. He's a great guy personally and in business. He's a beast. So shout out to you, Julian, and thanks for the hat. And he made those hats, and I actually liked them, and I asked him to send me one, which says "Make interest rates great again." And it happens that we are seeing some movements in interest rates globally and locally. So
his timing is absolutely perfect, isn't it?
Absolutely. So
but I'm not too sure about the purple colour though. It's given the slogan, it probably should have been a nice bright red. But
it's
anyway.
the purpose. So yeah, it looks like it's working. Maybe we'll do T-shirts next and see where that leads to.
I'll leave that to you, Eddie. Very good. Look, let's get into it. I think there's obviously a lot to unpack when it comes to interest rates. It's a hot topic as it stands at the moment, but it's probably a good way to start by talking about what's the actual relationship between interest rates and inflation, because that's what everyone's talking about. That's what the RBA are always conscious of as well. So Probably good to give some background, Eddie, on that side of things.
Yeah, absolutely. And I think it's worth noting what actually inflation means, because we hear it a lot, and I feel like sometimes we don't get into what it actually means. And it literally means the percentage in prices and growth. So how much have prices gone month on month or quarter to quarter? And we measure that increase, and that is basically what inflation is. So moderate inflation is important for economies, and it actually shows that there's a growth happening and the economy is moving forward. When inflation is high, this is where it actually can lead to dangers and where it's not healthy, and that's what we've seen over the last few years, which can discourage investors and makes people not want to invest in markets or properties or whatever it is, and stick to cash deposits and that sort of stuff.
Yep.
So that's where inflation is, and interest rates play a huge role in moderating inflation in a way where the Reserve Bank uses the interest rates to try and influence inflation, whether to drop it down or to push inflation higher. Like we've seen during COVID, they lowered interest rates to incentivize people to spend more money, and that pushed inflation to a high level, which they're trying to bring back down over the last 2 years by increasing those interest rates. And we can see that inflation is actually cooling down a bit. They still say it's a bit sticky in places, or still not within the certain levels they're comfortable with, but at least we've seen some cooling down in inflation in compared to where it was a year ago. Okay. So we're probably halved inflation now from 7-8% peak to 3.5% now. So that's where interest rates played that role and pushed inflation back.
So on the back of that, Eddie, what are the real potential effects of raising interest rates on consumer spending? So there's probably two parts to this. And also, what are the risks of actually lowering interest rates in an inflationary environment? So, getting that right level.
Yeah, look, if we go through the first bit of increasing interest rates, when Reserve Bank increases the cash rate, that's what the interest rate is, that pushes people to actually invest in term deposits,
Mhm.
where it becomes safer to put your money in cash in a term deposit and earn a certain percentage income on that
Mhm.
return, rather than invest in the market, where that can be a bit more risky, because inflation technically eats out of the investment that you've made. So let's say you've invested $100,000 somewhere, you're earning a return of 4%, but inflation is sitting at 6%. You're technically losing 2%.
Yeah.
So that's where reserve banks increase the interest rates to make people withdraw funds or cash from investments, and mainly in the property market, where we are probably more focused on. So that actually helps in cooling down property prices.
Yep.
It helps out, and especially in Australia, the property market is huge, and everything pretty much is connected to the property market.
It's
and
pretty much revolves around it, doesn't it?
Exactly. So when that cools down, you've got so many other things that actually cool down, and that helps in reducing inflation. Now, the second part of the question, where what happens if they lower rates when inflation is not within target. So I think that's what the RBA has been trying to work out for the last couple of years. And it's a very tough one, because you don't know what the actual magic figure is. And there's always a lagging effect. So if they lower rates today, like, you're going to see a lagging effect in 3 to 6 months' time. And then by the time they take action, they're already running behind. So that is the biggest challenge. And I guess, Carlo, the second part of the question is the risk of lowering interest rates and the risk on inflation. And I guess that's the biggest challenge the RBA has been facing over the last couple of years. And there's a big push, people, demanding interest rates to be dropped. But obviously, inflation is still not within the range the RBA is comfortable.
They're running a very cautious ship, though,
Yeah,
aren't they?
exactly.
The RBA.
And I guess that's... There's obviously a risk involved there, because if the RBA is looking at it from a point where, I guess, 30% of the Australian population has got mortgages, and the biggest chunk of people affected by interest rates are mortgage holders. So they're saying, if we reduce interest rates and help the 30% mortgage holders, even though not all full 30% are hugely affected, then we're risking the whole economy and pushing inflation and prices up even further. So that's the risk of reducing rates immaturely, I guess, and run the risk of pushing inflation back up when they've been trying for the last 2 years hard to bring it back down. So, it's a very cautious movement.
And it probably leads to my next question or comment around, just how quickly that if the RBA does pull the lever on a rate cut, for argument's sake, how long does it typically take to affect inflation? You talked about that lag effect. So, roughly, I think people say, well, if say the Fed's just cut the rates by 0.5%, why aren't we doing the same thing as well?
Yeah.
Because there is a lag in terms of, if we do something, if the RBA does pull the lever, how long does it take for it to actually start affecting inflation?
Yeah, I'm not an economist, but I can reflect on what I've seen during my 10 years period in the mortgage and lending space. And if we go back as recent as COVID, and how things turn around pretty quick, and people get that sense of FOMO, where there's a fear of missing out, interest rates are low, everyone wants to get into the market. The market there's gains, huge gains to be made in a quick, short period of time. So that pushed prices in a very short period of time, like in a month or two, the market was running really hot. From running really low and risky and not sure about what's coming next, to everybody jumping on the market, and the market has gone up probably 30-40% during COVID period. So the turnaround is pretty quick, but in an economy sense, I think there is a lagging effect until that reflects on the census or the data or whatever the RBA goes by. It could take a few months until it's reflected, because when they run these CPI reports, like, it's usually 3 to 6 months behind.
Exactly. Yeah.
So yeah, I'm not 100% qualified to actually say how long it takes, but depends on the actual market and the RBA data, and that's where the lagging effect is. So yeah, I don't know if that answers the question.
Yeah, well, I think it's just good to give our listeners a bit of a sense as to how the timing works for it all, because a few people out there would be thinking that it's almost instantaneous. Well, it's not. It actually does take a while for things to flow through the economy, changes to spending habits, etc. So, and it's on both sides. If inflation does start to pull back, when is it before we start to know what those measures look like, and when the RBA decides to actually do something about it as well? So
absolutely. And I guess also a few things to probably reflect on in our current Australian market regarding interest rates.
Mm-hmm.
In the last few weeks, we've seen a lot of lenders cutting their fixed rates, 2 and 3 years fixed rates.
Yeah.
And the way I guess we look at it is banks always come on top. So they know that they might lose a bit in the first year if you fixed your rate with them for 2 and 3 years. But they've got the sense that interest rates are going to be dropping over the next couple of years, and they'll end up on top in that sense. So we're seeing mid-5 interest rates now for fixed 2 years. So that is a probably indication on what's to come, and that gives a lot of people some hope that we're actually seeing the light.
I think you're right. It does give people a bit more hope when they start to see the banks starting to drop their fixed rates. But we've talked about before that the banks are pretty clever at predicting where rates are going to be in the longer term, and they're not in the business of losing money, that's for sure. So they're typically going to set it at a point where they know, they may take a bit of a hit up front, but over the longer time frame, they're going to still make money out of it.
Absolutely.
and not lose out on it. So
absolutely. And I guess that probably worth us reflecting on how interest rates have been in Australia, and like a bit of a historical context in the last probably decade on how interest rates are and where we are now.
Yeah, and it's a good thing to be talking about in terms of reflection. And if we look at the last 10 or 12 years, or probably 10 or 11 years, I'll probably take it back to August 2013, where the RBA was starting to move towards reducing rates, the actual cash rate, and they dropped it down to 2.5%. And then we saw a period of around August 2016 through to June 2019, where we saw rates on hold at 1.5%. So that was a nice, stable environment that the economy was in, where there was a lot more stability. Rates weren't moving upwards or downwards, so things were probably chugging along quite nicely. And then we had that wonderful thing called COVID hit our shores, and globally, really, at the end of the day. And that saw a lot of changes from people's spending habits, people stockpiling cash, and all of a sudden we started to see, as we spoke about earlier on, inflation starting to really get out of control. But what we also saw was the RBA wanting to pull the lever on cutting rates. They wanted to, there was a lot of people who lost their jobs, was stood down for a period of time. So there was a lot of pressure on making sure we didn't push the economy in the wrong direction. So we actually saw 6 rate cuts, I think, in total over that period, to where we got the cash rate down to 0.1%, which effectively like free money.
Yeah.
And in actual interest rate terms, in terms of what the banks were actually charging, that was probably meant a rate of about 2%. So very cheap. We'd never really seen anything like it. We saw clients who were fixing in a 1.99, 1.89 or thereabouts. So, but then, if we fast forward out of COVID, it probably took until about May 2022 when we started to.
That was the first, probably.
Yeah, hike. the first of the rate hikes, because I think we got inflation up to around that 8.5%. So way too high. We've got an RBA target band of 2 to 3%, and all of a sudden we've got inflation sitting at 8%. So way too high. RBA decides, well, we've got to start raising rates to really rein that back in. And we saw and I counted this up the other day, 13 rate rises in total, 10 of them in a row, which everyone's quite aware of, and it impacted a lot of people as well. And that final rate rise took us to where we stand today, which is a cash rate of 4.35. So we've seen the cash rate go from 0.1 to 4.35 in the space of just a few years, which is massive. We'd really never really seen levels like that, in terms of rate hikes that quickly in that short period of time.
Probably a year and a half.
Yeah. So, what that saw was rates going from around that 2% level up to where we stand at the moment, around the 6.5% level. So, the average mortgage holder, that makes a massive difference. People are having to fork out a lot more in after-tax pay to pay for their repayments. So, definitely has had a massive impact. But like you said, hopefully we're starting to see some light at the end of the tunnel.
Yeah. Well, I guess it's working in a sense where like inflation is going back down.
Yep.
But that's the thing, like it's not fun. It's not like, we read about the Great Depression or historical moments where the economy was bad and you think, oh, they must have managed somehow. But we're probably living a fraction of it. And I can tell you a lot of people are not happy about it because you're pretty much just working to stay on top of things.
Yeah.
So people usually during those periods are not saving as much. They're not spending on luxury items or holidays or whatever it is as much as compared to like during COVID when money was free. You could look at luxury items like watches skyrocketed and
holiday
houses, yep. Fancy cars, that's where people start. They've got more money and then they start spending on luxurious items, I guess. So
and I think back to my early days when I first started in banking, where the average home loan owner was paying 17.5%, 18% on their mortgages, and you sit back and you go, how do they actually do it? Because wages are obviously a lot less in those days as well. But in the same token, prices of properties were nowhere near where we are at the moment.
True.
So still a bit relative, but
and lifestyle was not
correct. And that's what I was pretty much alluding to, is that lifestyle's probably changed a lot as well over the time. So
I guess that's a big one. I guess where we take a lot of things for granted, when really, if you go back not too long ago, 20, 30 years ago, a lot of the things we take for granted now, we're not there, and we obviously have to pay for these things. So, and that's going out of your income. So people need to factor for those, I guess, in a way.
So it's probably safe to say that where we're seeing rates at the moment and what the RBA's done with the overall cash rate, have we really seen it help control inflation in this economy?
Well, it definitely reduced it. It definitely put inflation back in a non-dangerous zone, I guess. Me personally, I believe there should be like some serious restructuring on how we actually do this, because it's going to keep like happening over and over and over again, where you go through cycles of recession and then go through cycles of growth, and then it's going to keep happening. But we need some serious reforms, I guess, in tax structures, in certain loopholes that multinational and billionaires use to escape paying.
There's lots to consider in there, and we don't want to get probably too political with regards to this, but even things like, and I've spoken to a few people about this in the past, is the RBA's inflation target band of 2 to 3%. I think from memory it was set like many decades ago. Is that relevant in today's society? Is that still the most appropriate band, or is coming out of COVID, should that have been shifted in one way?
I don't know.
It's an interesting question.
And obviously wearing this hat, I don't want to be pushing the conservative ideas, but I'd rather be a bit more conservative and work within that 2-3% band than just push towards more inflation and just more
Yeah.
spending, which I don't think it's a good strategy long term.
Yeah. And I think the overall thing with the changes in interest rates is that, our conversations with our clients are starting to change as well.
Yep.
6 months ago, we were not talking to really any clients about fixing their rates.
4 weeks ago.
Sorry, I was trying to be generous there, but you're right. And you're right. It probably was only 4 weeks ago. And but what we're seeing now is because and you alluded to earlier on about fixed rates getting down into the mid fives. So all of a sudden we're seeing that shift from fixed rates being higher than variable rates to now being lower. So the conversation begs with clients is, do you look to now fix your loan? Do you look to fix maybe part of your loan? I think it's always a good strategy to have that bit of a mix. It's like hedging your bets to a certain degree as well, isn't it?
Yes.
So, but yeah, our conversations are definitely changing,
100%.
aren't they?
And you've had a few. I've had a few in the last weeks. I'm working on a few where they are actually fixing part of the loan, because looking at it, and obviously there's a risk involved there, but from the logical point of view, we're looking at it, and customers obviously are on board with it, is if we're fixing our loan for 2 years we've got a 5.59% interest rate on offer at the moment. So if we're fixing for 2 years, 5.59, that's about 0.6% lower than the current variable rates in the market. So if the RBA drops interest rates by 0.25, they have to do it 3 consecutive cuts until it's actually becomes lower than that fixed period. So, and a lot of speculation, probably like this is changing very quickly these days, but no one is expecting the RBA to cut interest rates by more than 1%, at least for the first year.
Yeah, correct. Yeah.
So you're still ahead for the first year, and then you balance out in the second year, depending how that's going to be. So you might still be ahead, or at least on par by leaving your rate variable. But the only difference is it's giving you some sort of certainty in terms of what to expect in your repayments for the next couple of years. And also, like you said, hedging your bets where you're leaving part of that loan as a variable to benefit from further rate drops, or using that offset account for offsetting the interest and making some extra repayments. So it's just trying to find the balance in the current environment.
Yeah, and I think it's probably a good opportunity to have a quick chat about the Big Four, the Big Four banks' rate predictions over the next 12 months, because that's typically a good indicator as to where we think the interest rate's going to land. And I was just having a look at this morning, because up until today or yesterday, I think 3 out of the Big Four banks weren't predicting any rate cuts this year. CBA was the outlier, who said they were predicting one in November this year.
I think they changed it.
They changed actually this morning to December this year. So they still see a glimmer of hope for a rate cut in December this year. But I think everyone's starting to lean more towards that first rate cut sitting around March next year. And if I look at most of the banks, they all pretty much land at the same endpoint, which is about a 1% reduction in the cash rate up until end of next year. So I think I wouldn't say it's safe to say, but everything's obviously leaning in that direction. So
yeah, and obviously economists do a great job, but if I learned anything over the last 4 years, is a lot of people have no clue what's going to happen. And especially in current economic outlooks, it's very dynamic. It changes very, very quick. There's a lot of variables involved in it. So it's not just pure economy. There's obviously politics involved. There's war involved. There's a lot of stuff involved in it. So the economists have been trying to predict over the last 4 years what's going to happen, and probably 99% of the time they missed it. So we can look at these figures and say that's the cash rate prediction, but it is a prediction. So
correct,
we never know. Yes, like you said, everything's showing that we might be seeing the light at the end of the tunnel. We might see some rate cuts soon, but there's still predictions, and like we can't take it for granted
Yeah, and I think we heard in the market the other day that obviously with the US Fed cutting rates by 0.5%, straight away people are going, oh, this is going to force the RBA's hand to start cutting rates here in Australia. But reality is that's not going to happen because, as you mentioned, there's so many other things that are in play here. It's not just about unless the US Fed's cut rates, we've got to follow suit. Unfortunately, it's not that easy, that's for sure. But what it does lead towards is that most of the developed countries in this world are starting to get their inflation under control. So they're starting to move towards that easing bias, which is good for us, really.
Hopefully
Fingers
it's
crossed
good for us, because that's the thing. Like, we still don't know what cutting rates mean. Even the US Fed cutting rates, and obviously, like you said, tapping into this topic is very edgy. Like, first of all, it's
put on the economist hat. You want to switch
hats?
hats?
Not really. It's just as an observant. Yeah. Not a professional opinion. Just my personal reflection. And like, we don't know if that's the right move. Is it based on, especially to cut your interest rate straight by 0.5%? Like, is that a panic move, or is that a calculated move? Is that a political move?
I was just about to say, might have something to do with the fact that there's an election happening in the US this year. So.
And then, probably mortgage holders are relieved and people are happy because, the economy's recovering. But I guess we just need to wait and see how that's going to be reflected in reality.
Time will tell whether it's a smart move or a very knee-jerk move. So
I guess that takes us back to, don't get hyped by what's going around. Stick to what you can actually afford and work within your budget, within your limits. Even be conservative in that way, because we've seen it. I've seen it during COVID with a lot of people going out there buying 2 and 3 properties, over leveraging, over exposing themselves, and then as soon as the economy changed, as soon as interest rates changed, they were in a very bad position, and some of them had to sell some of those properties. So it might seem like we're going towards better days, but just stay conservative. It's worth also maybe touching on, if we see some rate cuts to come, how would that reflect on an average mortgage holder in terms of repayments or borrowing?
Yeah, no, probably good to give our listeners a bit of an idea in terms of a couple of different examples in terms of what the effect will be. I don't think we'll see a 0.5% reduction like the US has done, but it's good to give people an idea. And I've just worked out some very quick numbers based on an average loan size of $500,000, which is probably close to the mark in this country. But a 0.25% reduction in the actual interest rate will see mortgage holders save about $82 a month in their repayments.
Okay,
so still not too bad.
$4,000 a year.
Exactly right. Everything helps really. At the end of the day, if we look at, if we receive another rate reduction down the track as well, and also with now 0.5% lower than what current levels are, that amounts to about $163 a month on a $500,000 mortgage. So, you start to build in, double that amount. If we get a 1% reduction in interest rates over the next 12 months, you can literally double that. So we're talking over $300 a month in a reduction to your mortgage repayment. So
that's decent.
Very much so. And I think it'll be a welcome relief for a lot of mortgage holders out there. So yeah.
I'll be holding you to that. Hopefully. Yeah.
We'll put a disclaimer at the end of this.
Do you want to put
podcast.
your prediction?
No, definitely
Come
not.
on, let's do one.
No,
Time will tell. No.
Thank you, but no, thank you. So,
all right, I'll put mine in. I think we're going to see a rate cut in December.
Ooh, that's a big call. No, I'm holding out. I think it'll be that the RBA will hold fire and do it in probably March next year.
March.
Yeah, March. I think pulling the trigger this side of Christmas could backfire on them. I think it'll see a lot of people go out there and
spend
think
more.
It's Christmas.
Holidays.
It's Christmas times too. I know it's Christmas, but they'll end up spending the money before they've even earned it. So I think they're just going to be a little bit wary because there's going to be that lag effect as well in terms of inflationary numbers. So I'm still going to hold out for
time will tell
for March next year, but I still think there'll be at least a 1% reduction in the cash rate between now and end of December 2025. So
Yeah. Well, let's wait and see.
yeah, exactly.
I guess we've covered quite a bit today, and it was a good topic. So we'll wrap it up. Yeah.
Fantastic. Yeah.
All right. Cool. Thanks for listening, everyone. And please don't forget to subscribe to our podcast and leave us any feedback or comments or questions. We are actually planning on doing a Q&A session. So we'll be collecting questions that we get asked all the time and run a podcast on them. So until then, stay safe and see you soon.
See you later, everyone. Take care.